Today we're going to be covering Chapter 11, which is Cash Flow Estimation and Risk Analysis. The comic for this particular chapter is our entire operation is sustainable except for our cash flow. Yes, it's often easier said than done to be able to generate positive cash flow. So we're going to look at three main areas in this chapter. The first are just how to estimate cash flows. And we're going to do a brief review of some of the key concepts related to relevant costs and how to go about some of the major elements of cash flow. Then there are three areas that tend to be a little tricky. So we'll do each of those one at a time: depreciation expense, gain or loss on a sale of an asset, and also working capital and how to account for that in the cash flow analysis. The second major topic is risk analysis, and here we'll look at three different techniques. The first being sensitivity analysis, which looks at the individual assumptions and which ones have large bearing on the results. The second is scenario analysis, where we look at different circumstances that we call scenarios, which may involve changing multiple assumptions given each of those scenarios. And third, simulation analysis, which uses some statistical techniques in order to measure what would happen overall with some changes in some of the key assumptions that have certain probabilities. So it's a statistically based estimation technique. And the third is we'll look at real options and be able to expose you to a valuable technique of the decision tree. So let's jump into the material. All right, so we're going to use this flowchart, and once again it looks very similar to what we've seen throughout the course, but a couple of things are different from what we've used most recently. That was for firm valuation. So here we're looking at a project and not a company. The numerator is still cash flow, but here it's not called free cash flow as it was in company valuation. It's cash flow from the project. The denominator still has a discount rate that reflects the time value of money, and it is going to be a risk-adjusted project return. And we've used WACC for company valuation, but here we're going to look at a project-specific discount rate. And of course, it could be based on the WACC of a company, but the company should adjust the rate upward if the project being considered is riskier than the general risk of the company, and they should adjust the rate downward from WACC if this particular project is lower than the average risk for the company. So that's how we make adjustments given the parameters of a particular project. All right, so let's start with looking at estimating cash flows, and with some initial review of what you may have seen during Mod A in your managerial accounting course. So these are the key concepts. First, that is incremental profit. We're not trying to estimate the total profit of the company or even of a division. We're trying to look at incremental profit. So it allows us to ignore all the other things that may be happening in the company. So we're going to look at the cash flow with or without a particular project, or in the case of multiple projects, among the various alternative projects, which one generates the most cash flow. So then we look at relevant costs. So we're going to look at those costs that are cash flows that are in the future that differ among alternatives. So remember the words future and differ. And so let's look at how to apply those against some common scenarios. First is sunk costs. Sunk costs are expressly not relevant because they happened in the past. They did cost you money, and let's say it's R&D and it cost you $50 million. That's pretty painful to spend that kind of money with no return as of this point in time. But those are sunk. What's relevant is here and now and tomorrow. Should we continue funding the project? And what are the expected cash flows if we do continue to fund it? So that's how we look at sunk costs. Second, we'll look at incremental costs. So these are by definition, since they are added to the decision. So it's what's happening next with the project as opposed to things that have already occurred in the past. Third, we'll look at opportunity costs. Opportunity costs are embodied by you right now. You came to HALT and you had an opportunity to do many other things. You could work, you could travel, you could pursue your education in another field or another university. So there are opportunity costs for all resources, and often they are forgotten. So don't forget about opportunity costs. Next, we'll look at externalities. First, we'll look from the standpoint of externalities that are internal. That almost seems like a contradictory statement. But what we're referring to here is that a project has certain impact on other projects or other divisions or parts of the company. And that's what we mean. That effect might be positive in that there might be cost synergies or cost reductions so that your project favorably impacts another project or division, in which case we call it a positive externality. Negative is where we could lose something somewhere else. The simple example or common example is what we call cannibalization, where by selling your product, you take away sales of an existing or an alternative product that your company has. Also, there could be a negative externality related to the cost of operating the business. There are also, of course, true externalities, which are external externalities. Now, that might sound redundant, but here what we mean is that there are some things that affect outside of the company in addition to what our intended cash flows are. And so that's why I said it's not a technical term. This may be an environmental externality, and those are important considerations, but they're often difficult to quantify directly into a financial evaluation of cash flow, but they're nonetheless relevant considerations. Next, we'll look at financing costs. It is tempting to consider something like interest expense a financing cost, but that's the entire purpose. If you think about what the weighted average cost of capital is, or what is the purpose of the required rate of return. So we ignore financing as a part of the cash flow because it is the basis on which we have a discount rate. All right, next we'll look at inflation. So there's two choices, and what the idea is be consistent. So if you're going to keep everything at nominal, which means take into account the effects of inflation, do so with all the elements of your model. If you want to keep it at the real interest rate or real inflation rate, then keep it with no inflation for any of the elements. So again, just be consistent and your analysis should be fine.